In this video, I am going to discuss about financial institutes and financial intermediaries. Financial institutions are organizations that offer financial services to individuals, businesses, and governments. These services can include deposit taking, lending, investing, insurance, and other financial activities. For examples, insurance companies, banks, credit unions, investment banks. Financial institutions are regulated by various government bodies and must adhere to specific legal and ethical standards. In the most cases, central bank of that country is the regulatory authority over the financial institution. They play a crucial role in promoting economic growth and facilitating the flow of funds in the financial system, reducing transaction costs and providing liquidity and diversification options to investors. There is a slight difference between financial institutes and financial intermediaries. In a broad view, we can use the financial institutes and financial intermediaries interchangeably. But you need to aware of what is the specific difference between these two terms. Financial intermediaries are a subset of financial institutes. In other words, not all the financial institutes are financial intermediaries. This concept is illustrated here very clearly. Financial institutes is the broad term we use for institutes that operates and provide services in the context of finance. And financial intermediaries are a subset of financial institutes, just like stakeholders and shareholders. Shareholders are a subset of stakeholders. Not all the stakeholders are shareholders, but shareholders are a group of stakeholders. Just like that, not all the financial institutes are financial intermediaries, but financial intermediaries are a subset of financial institutes. Here are the examples for financial institutes and financial intermediaries. Financial institutes, central banks, commercial banks, investment banks, stock exchanges, credit unions, insurance companies. These are just few common examples. Financial intermediaries, mutual funds, insurance companies, pension funds, venture capital firms, mortgage companies. Now let's discuss about the term intermediation. Financial intermediation is the process by which financial intermediaries such as banks, insurance companies, and investment firms act as middlemen between savers and borrowers in financial transactions. Between savers and borrowers. Savers deposit the money, borrowers borrow the money. Financial intermediaries are institutions or entities that act as a middleman between savers and borrowers in the financial system. This is the difference between financial institutions and financial intermediaries. Financial intermediaries are middlemen between savers and borrowers. Financial intermediaries also provide other financial services such as financial advice, risk management, and investment services. Banks are the most common example for financial intermediaries and credit unions. Now you know the difference between a financial institute and a financial intermediary. We can divide financial intermediaries into two types, deposit taking and non-deposit taking. Let's talk about deposit taking intermediaries. Deposit taking intermediaries are a type of financial intermediary that accept deposits from savers and use those funds to provide loans and other financial services to borrowers. These are the examples for deposit taking intermediaries. Banks. Banks are the most common example of deposit taking intermediaries. They accept deposits from individuals and businesses, such as checking accounts, saving accounts, and certificate of deposits, and use those funds to provide loans such as mortgages, car loans, and business loans. Credit unions. Credit unions are similar to banks in that they accept deposits from members and use those funds to provide loans. However, credit unions are typically owned and operated by their members who share a common bond, such as working for the same company or living in the same area. Saving and loan associations. These are financial institutions that specialize in accepting deposits and providing mortgages and other home loans. Building societies. Building societies are financial institutions that operate similarly to credit unions and specialize in accepting deposits and providing mortgages. Online banks are financial institutions that operate solely online and accept deposits from individuals and businesses. They typically offer higher interest rates on deposits and lower fees than traditional banks. Now let's discuss about non-deposit taking intermediaries. Non-deposit taking intermediaries are financial intermediaries that do not accept deposits from savers but instead raise funds in other ways, such as issuing securities or obtaining loans from other financial institutions. These are the examples for non-deposit taking intermediaries. Mutual funds. These are a type of investment intermediary that pools money from many investors to buy a diversified portfolio of securities, such as stocks and bonds. Hedge funds. Hedge funds are a type of investment intermediary that raises funds from high net worth individuals and institutional investors and invests those funds in a variety of financial instruments such as stocks, bonds, and derivatives. Insurance companies. Insurance companies are financial intermediaries that sell insurance policies to individuals and businesses to protect against various risks. They invest the premiums they collect in a variety of financial instruments to generate returns. Pension funds. Pension funds are financial intermediaries that manage retirement savings for individuals and invest those funds in a variety of financial instruments to generate returns that will provide income in retirement. Factoring companies are also a type of intermediaries which provide services to businesses to collect their debts from their customers. Venture capital firms. These are also a financial intermediaries that invest in early stage companies with high growth potential in exchange for an ownership stake. Private equity firms. Private equity firms are financial intermediaries that invest in established companies to buy them out, restructure them, and then sell them for a profit. Now let's discuss about different types of banks. Commercial banks. Commercial banks are banks that primarily offer services to businesses and corporations. They provide a range of services including deposit accounts, loans, credit cards, foreign exchange, and trade finance. Investment banks. Investment banks that specialize in providing financial advisory and underwriting services to corporations and governments. They assist clients in raising capital by issuing and selling securities, such as stocks and bonds. Central banks. Central banks are government owned banks that are responsible for implementing monetary policy and regulating the financial system. They also act as lenders of last resort to commercial banks during times of financial distress. We discussed about central banks in a separate video. Cooperative banks. Cooperative banks are owned and operated by their members, who are typically individuals or small businesses with a common interest, such as living in the same community or belonging to the same profession. Islamic banks. These operate according to Islamic finance principles, which prohibit interest based transactions and require investments to be made in socially responsible activities. Now let's discuss about commercial banks. Commercial banks are financial institutions that primarily provide banking services to businesses and corporations. Banks are also a financial institute as well as a finance intermediary. We now know about this. They accept deposits from businesses and provide loans, lines of credit, and other financial services to help them grow and manage their operations. Commercial banks also provide a range of services to individual consumers, such as deposit accounts, credit cards, mortgages, and personal loans. There are two types of commercial banks: retail banks and wholesale banks. Retail banks do transactions with regular individuals and businesses, whereas wholesale banks are do business with large institutes and financial firms. These are the common services that commercial banks provide. Deposit accounts. Commercial banks offer a range of deposit accounts such as checking accounts, saving accounts, and money market accounts to businesses. These accounts allow businesses to earn interest on their deposits, make payments, and manage their cash flow. Loans and lines of credit. Commercial banks provide loans and lines of credit to businesses to help them finance their operations, purchase inventory, or invest in new projects. These loans can be secured or unsecured and may require collateral. Overdrafts. An overdraft is a financial service offered by banks that allows a customer to withdraw more money than they have in their account up to a predetermined limit. When a customer spends more money than they have in their account, the bank will cover the shortfall by extending credit to the customer. Credit cards. Commercial banks offer credit cards to customers, which allow them to make purchases and pay for them at a later date. Credit cards come with various features and benefits, such as cashback rewards, travel rewards, and low interest rates. Wealth management services. Commercial banks offer wealth management services to high net worth individuals and businesses. These services include financial planning, investment management, and estate planning. Foreign exchange services. Commercial banks provide foreign exchange services to customers, which allow them to exchange currencies to travel, business, or investment purposes. These services may be include currency exchange, wire transfers, and foreign currency accounts. Trade finance. Commercial banks provide trade finance services to businesses to help them manage their international transactions. These services may include letters of credit, exporting finance, and importing finance. Treasury management. Commercial banks offer treasury management services to businesses to help them manage their cash flow, liquidity, and risk. These services may include cash management, checking process, and electronic payments. Now let's discuss about credit creation by commercial banks. This is a very important concept when it comes to macroeconomics. Credit creation is the process by which commercial banks create new money by lending to borrowers. When a bank lends money to a borrower, it creates a new deposit for the borrower, which is recorded on the bank's balance sheet as a liability. The borrower can then use this deposit to make purchases or pay bills, effectively creating new spending power in the economy. Process of lending depositors money to borrowers, which increases the money supply in the economy. This is the credit multiplier effect. We discussed about this multiplier effect in an early video. Now let's talk about the cash ratio. Banks are required to hold reserves, cash or liquid assets to ensure they have enough funds to meet the demand for withdrawals from their depositors. What is liquidity? The liquidity of a bank refers to its ability to meet its financial obligations as they come due without incurring significant losses. A bank is considered to be liquid if it has sufficient cash and other assets that can be quickly converted into cash to meet its obligations. The liquidity of a bank is important because it allows the bank to meet the demand for withdrawals from depositors and to make payments to its creditors. If a bank is illiquid, it may be unable to meet these obligations, which can lead to financial distress, loss of confidence by depositors, and ultimately a bank run. A bank run is where all the depositors withdrawing their money at once. This is a very serious situation. To avoid these situations, the reserve requirement is set by the central bank of a government and varies depending on the banking system and economic conditions. This reserve requirement is the cash ratio, which means banks have to retain a percentage of depositors' money in the bank at all times, which means banks have to retain a percentage of depositors' money in the bank at all times. This is for the liquidity of the bank. The other portion of the money can be lent out to the borrowers. This is the simplest explanation for cash ratio. You go to your bank and deposit $100. So this is a deposit. This is the bank. What the bank has to retain a percentage of your deposit in the bank at all times. The other percentage can be lent out to the borrowers. This is to maintain the liquidity of the bank. So let's say the cash ratio is 10%, which means now the bank has to retain 10% of your deposit and then the other percentage can be lent out to the borrowers, which is 90%. This is how we can calculate the cash to retain in the bank. This equals to deposit amount multiplied by the cash ratio. Cash ratio for the banks will be decided by the central bank of that country. And then we can calculate the cash available to lend out by the bank, which equals to deposit amount minus the cash to retain in the bank. Let's say you are depositing $100 in your bank account. If the cash ratio is 10% for your banking system, then the cash to retain in the bank will equals to 100 multiplied by 10%, which is $10. So the bank has to retain $10 in the bank on your deposit. This is how you calculate this 10 over 100 because this is a percentage. You cannot just use the 10 as it is. You have to convert this percentage into a decimal. You can divide this percentage by 100 and get the decimal value. So the cash available to lend out by the bank equals to deposit amount, which is $100 minus the cash to retain in the bank, which is $10. So $90 can be lent out to the borrowers. This will lead to a credit multiplier effect. We discussed about multiplier effect in an early video. Now that the bank can lend money to the borrowers, this will create a credit multiplier effect. This means the initial amount you deposited in your bank account will multiply the money supply in the economy. This is how you calculate it. 1 over the cash ratio multiplied by the initial deposit amount. So let's calculate it. 1 over cash ratio is 10%. We have to convert this 10% into a decimal value multiplied by initial deposit amount, which is $100. So this equals to $1,000. This means if you deposit $100 in your bank account and the cash ratio is 10% for the bank, that initial $100 will multiply into $1,000 in the macroeconomic context. This is how it happens. You deposit $100 in the bank and the bank will retain 10% of your deposit, which is $10, and lend the other amount to borrowers, which is $90. This is borrowers. So the borrower will spend that money on something Let's say the borrower is borrowing money to purchase a vehicle. So borrower will spend the $90 on a car. So the person who is selling the car is now getting the $90. So the person who sold the car will save some of that money in his bank account. So again the bank has new deposit. So again the bank will lend out 90% of that deposit to another borrower. Like that, this will circulate in the economy. This will ultimately increase the money supply in the economy. This is the credit multiplier effect. Thank you for watching. See you in the next video.